give your portfolio a proper diversification. If you are investing into equity, your some portion will be into the large cap stocks, some portion into the mid cap, and some portion into the small cap kind of ideas, and especially into the mutual fund industries. China, countries like China and Japan, they are very much, their tariffs rate is around 104%. And if I see how it will impact on the India is a country where the lower tariffs are announced. We are only having a tariff of 26%. So we can see it as an opportunity also for an India. India can do very well for the long-term basis next 2-3 years if I compare it to the other countries.
Globally, Trump has opened the doors of a trade war. Whole scenario, the recession and global turmoil can bring us opportunities also. That our Indian inflation numbers will well be under control, under our estimates also, which will give us an edge to deal with the whole situation.
So my advice will be the new investors especially is like, stay invested, don't do any panic selling. Only that money into the equity market which you seen, that money is available for next 5-6 years. Don't do any short-term trading kind of ideas.
And if we talk about gold, there is certain panic in the market after there were news that the gold prices will fall significantly.
As far as Indians are concerned, we are always gold lovers. Like equities, if we go on a long-term returns of gold also, gold has given around 13-14% of compounding return since last 10-12 years. But if you see it in an absolute terms, last 3 years gold has risen and it's doubled. Gold was recommended as an addition by us 2 years back. We recommended coming out of IT and we recommended gold at those levels to our clients also.
5-10% to the gold, because gold is basically an investment which will perform when there is an uncertainty in the world. You can ideal return for every individual investor should be 13 to 15%. I think 12 to 15% is very good number. Don't rush it like your portfolio give you 20-25%. It's very risky.
Hi, you're watching The Savera. This is Amarpal Singh before you. Since Donald Trump has imposed tariff on trade partners, the stock market is melting down. And after China has imposed the retaliation tariff, we are seeing the tensions in the global market. It is further escalating. So to understand the market conditions, we are having with us Gaganpreet Singh as well as CA Mandeep Singh. They are financial advisors and representative of True Wisery Financial Services. They are currently managing 1,000 crore assets and they are having experience of over 20 years in the financial market. So welcome both of you in the Savera. And so starting with Gaganpreet Singh, in past few months we are seeing that there is decline in the stock market. So how you see the present conditions of the stock market?
Thank you, Mr. Amarpal ji, for giving us an opportunity and the Savera team. Your question is around how we see the present scenario of the stock market. First of all, regarding the stock market, I would like to give you a little brief about how our market is behaving from last 6 months and why there is a little correction in the market. For this financial year, what we are seeing in the markets, there are certain downtrend in the earnings season. What the earnings in the last year was around 15% as a normal earnings for all the Nifty companies, Nifty 500 companies. But this year we have seen a downward trend in the earnings of the companies. The earnings is around 5 to 7%. This is the main reason which we are seeing there is a correction in the market from the September to December onwards. Now again from the January onwards, we have seen Mr. Trump has announced the tariffs, and these tariffs is all over the world. They are especially tariffs are, they have announced it over the world. I would like to give you an example how it will impact our economy and how it will impact the rest of the world. If I compare China, countries like China and Japan, they are very much, their tariffs rate is around 104%. And if I see how it will impact on the India is a country where the lower tariffs are announced. We are only having a tariff of 26%. So we can see it as an opportunity also for an India. India can do very well for the long-term basis next 2-3 years if I compare it to the other countries. So yes, there is a turmoil in the market. Volatility will remain for next 2-3 months till the time all the trade wars will get settled, and this is an opportunity for India. So I would like to request to the Indian investors to stay invested and give some time in the market for next 2-3 years to get it settled.
CM Mandeep Singh ji, there is fear of global recession as well as inflation in the market?
Amar, I would like to say that certainly there is fear. There are chances of rising inflations across the globe. But I take this situation as two pieces of a paper. One is India, one is globe, except India. Globally, Trump has opened the doors of a trade war. Because of his tariffs, there will be reciprocal tariffs also. China initiated, they started with the reciprocal tariffs of 34%. America, Trump, he also reverted on the same terms. Now, with this and with European Unions and UK, they are also facing the same heat of tariffs. So, global recession will be the result of all these wars, which will be because of the increase in prices of the commodities going forward, resulting in inflation throughout. Now, as far as India is concerned, India basically is a consumption economy. With 150 odd crores of people, we reside 1/8 of the total population of the world, India. So, in this whole scenario, the recession and global turmoil can bring us opportunities also. We are net importers. Crude is the major import bill of Indian government that is falling. Today also in the monetary policy, RBI governor hinted on stable and consistent GDP numbers. And going forward with slowdown in food prices, controlled this import bill, we are expecting that our Indian inflation numbers will well be under control, under our estimates also, which will give us an edge to deal with the whole situation.
As Mandeep ji said that India is at good position comparatively to the other markets. So how you see observing the present market condition, what the new investors, how the new investors should react and how the long-term investors should react to it?
I think this is a very important question. From last 2-3 years after the COVID, all of the investors have only seen the one side of the market, which is suddenly up. And if there are a little bit correction has come, but rise in the market has come very sharply. And all the investors have seen a return of around 20-25% in their portfolios, which is actually not the right way to look at it. If I see the long-term returns of last 10 years, 15 years of the portfolios, it is still 13-14%, which is actually the right kind of returns for the every investors. So my advice will be the new investors especially is like, stay invested, don't do any panic selling in these kind of markets. Let your SIPs continue and stay at least come into the markets, put only that money into the equity market, which you seem that money is available for next 5-6 years. Don't do any short-term trading kind of ideas. Stay invested for long-term and you will see a very good kind of returns in India. Our economy is very strong and we are seeing it like you have seen the phrases like Amrit Kal and government is pushing for 2047 kind of initiatives. So for next 10, 12, 15 years, India is a very good place to be in. They can get the good returns, but stay invested for next 10 years. Then only you will able to see good returns in your portfolio.
And for the long-term investors?
I think long-term investors which we are trading, they don't panic in these kind of situations because they have already seen these kind of situations in their portfolio. They have seen the COVIDs, they have seen the earlier, I can say, Lehman Brothers fall. They have seen that markets, it's the nature of the equity markets. It will come down and it will again go up. Okay, so they are not panic. They are rightly doing buying at these levels. We have seen a lot of old investors, long-term investors are putting money in these kind of levels in the equity market. and they're just rebalancing their portfolio, which is very required in these kind of markets. I just give you an example. If we all understand how this tariff will impact on the segments like IT and the segments like the domestic based economy, the business which are only domestic into India. The IT is a global kind linked business, so there is an impact on the stocks like IT, Infosys down by 30-40% from their highs. And there are some companies like you can see Indigo, which is at 52-week high, because this is a domestic based airline business and which is doing very well. They have increased their sales 3 times in last 3 years. They are doing 20,000 crore sales, now they're at 70,000 crore sales with a 20,000 crores PAT. Their share is at all time high. No zero fall, that is not reduced in these kind of scenarios also. So we have to select the right way, right fundamental stocks and stay invested into those companies. Yeah.
So, like Gaganji said that he suggested that there should be no panic selling. And if we talk about gold, there is certain panic in the market after there were news that the gold prices will fall significantly. How you see the gold prices and how should consumers they should react to it?
Amarpal, we as advisors, we always recommend gold to be an part of your portfolio as investments. Gold we never see as a trading part, as a speculation game. We never recommend in gold. As far as panic in gold is concerned, like equities, if we go on a long-term returns of gold also, gold has given around 13-14% of compounding return since last 10-12 years. But if you see it in an absolute terms, last 3 years gold has risen and it's doubled. So when we see the macros of the economy, gold is taken as an hedge by governments also. The biggest treasuries of the world, they keep gold as hedge also and as an investment against bonds also. As retail investors, we always recommend keeping it part of your portfolio. Keep it as an hedge to equities also. Allocate some money. As far as Indians are concerned, we are always gold lovers. So practically there is no selling in the market. If you go practically see in the jewelers market or somewhere, we don't see any gold selling happening. No doubt at these levels people are not buying fresh physical gold, but in the form of ETFs we are recommending gold buying. At these levels we don't say that you go lump sum in gold. You do it in tranches, keep levels for it, average it out, but keep a portion of allocation to it. As Gagan rightly said, we need to rebalance things at times. Gold was recommended as an addition by us 2 years back. We recommended coming out of IT and we recommended gold at those levels to our clients also. But as of now, it's an hold position. Technically, it's in a strong up move.
There are various forms of investment. There are SIPs, there is gold, there is a stock market. So what is the right choice of investment at the present stage if we see the current market conditions?
I think for every investor, there should be an asset allocation model to their portfolio. If it is I have 100 rupees, so I should invest some part of it into the equity markets. Let's say I'm investing 60-70% into the equity markets. Rest there is a fixed income investments like fixed deposits, debt funds. I should park some money into these kind of funds also. And as Mandeep said, give 5-10% to the gold, because gold is basically an investment which will perform when there is an uncertainty in the world. And right now, today is an uncertainty in the world, the gold is outperforming. But it is giving hedge to the every portfolio. The mistake which every investor do, they just invest into those scenarios which they are basically return centering kind of investors. It means simply they only watch the historical returns. Let's say if you see the most investments in this last 6 months has allocated to the sector funds in mutual fund industry, like defense, like other various sectors. Everyone is invested on the sector funds. And we have right now we are saying that defense stocks are down by 30-40%, railway stocks are down by 30-40% from their highs, and all of the investors are stuck into these kind of funds or these kind of stocks, because people just chase the returns out of it. They need volatility, and the stocks are running like valuations are very expensive into these areas. So what we are advising give your portfolio a proper diversification. If you are investing into equity, your some portion will be into the large cap stocks, some portion into the mid cap, and some portion into the small cap kind of ideas, and especially into the mutual fund industries, because I have seen what the mistakes a trader do. They don't put any kind of stop loss into their portfolio. If they have bought a stock of 100 and it is now 10 rupees, it is still part of their portfolio. I can simply give you an idea. Yes Bank is the main common stock. If I see which is a major holding into the every demat. If I have a n number of demats, Yes Bank is a stock which is in everybody portfolio, and it has not delivered any single return from last 5 years, 6 years, 7 years. After the Yes Bank episode, it is at around 17 rupees. It is at 17 rupees 5 years back. But it is a part of the portfolio of every retail holders. They have Yes Bank. Only in the anticipation, it will go to 100 rupees someday. And they are not aware the company is not doing that much good and that much good business which is doing earlier. That is, there is a hit in the portfolio. So mutual fund is the only kind of zone which only invests into the profit-making companies. There are certain conditions. They will not invest into those companies which are having a high debt in their portfolios. Like you have seen that ideas. When the Adani episode happens, no single mutual fund has an holding on Adani stocks. So this is how mutual fund is. Mutual fund has done very well in this turmoil. Their average mutual fund portfolio is down by 10 to 11%. Rest of the markets, I have seen stocks are down by 30-40%. So give your portfolio proper diversification. Put some money into debt funds. Put some money into the gold ETFs, and put some money into the equities also. And it will. You can. Ideal return for every individual investor should be 13 to 15%. I think 12 to 15% is very good number. Don't rush it like your portfolio gives you 20-25%. It's very risky.
So they were Gaganpreet Singh and CA Mandeep Singh. So according to them, considering the present market condition, there should be no panic selling. And they also suggested that the investors should diversify their portfolio into different choices of investment. They should put their money in small cap. They should put their money in long cap, as well as in some portion in gold and different forms of investments. So stay invested for long term. You are watching The Savera. Follow us both on Facebook and YouTube, and also download our mobile application. Amarpal Singh with cameraman Manoj Sidhu.